Good morning and good evening everybody, welcome back to AZ Trading. And on the 30th of November, just a few days ago, I placed a trade on the S&P 500, one that you can see within this chart, and this might just be the last video I make on this channel.
Oh, just kidding, just kidding.
I'm just messing with you guys. It's kind of clickbait, kind of not. I'm going away for a few weeks, just for the month of December, just taking some time off with the family. So just giving you guys a little heads up that there won't be any more videos for the next few weeks. However, I'll still have access to Discord, so you'll probably see me in there chatting every now and then. But just a quick message on the Discord community server. So I've done a little remodeling of the server, but the biggest change I've implemented is in this roles channel up here. For example, if you trade indices, if you don't select this indices circle here, then you won't be able to see the indices chat rooms. Same thing for Forex. If you don't click the Forex role, you won't be able to see those chat rooms. But other than that, let's get into the trade that we'll talk about in this video. So I'll just turn on my executions as always, so you can see where my orders took place and the labels. And no, I didn't blow my account with this ridiculously large stop loss. This was just clickbait. I apologize. I suppose this will be my last video for a little while, so let me have my laugh. But no, we didn't blow our account on this trade, but we also didn't manage to take advantage of that move. Our trade, in fact, was before this news event, where we captured a short move during the New York session just after the equity open over here. And we've taken a few partials along the way. With 10% left to run just ahead of the news, you can see that we were stopped at break even. So this will be the trade that I'll talk about, and I'll just keep this video short and sweet. So first we'll cover the daily bias. So why was I looking to place a short instead of a long? Then we'll go through the RMR pattern, which found this very precise entry. And to top it off, we'll talk about relative strength. So why did I choose to short the S&P and why didn't I short the Nasdaq or the Dow? Alright, so first things first, daily bias. Now obviously in hindsight, you can see that my daily bias, which was to be bearish, and the day's actual bias, which was a very bullish day, were not aligned. And that's okay, because our daily bias is simply that. It's ours, it's not the market's. We have no idea what the market's going to do, but all we can do is make a logical decision on which direction, bullish or bearish, will be the more likely direction, and that will be our bias. So one of the easiest ways I use to find a daily bias is to just do a simple liquidity analysis. What that means is, let's have a look if price was starting before the New York Open. Let's imagine price is over here. So at this point in time, how would I do a liquidity analysis? All I'd do is I'd look above price and I'd look below price, and I'd mark out all the key areas of liquidity that are close by. So what I mean by this is, if I go onto a 30-minute chart, you can see when price is over here, if we look above price, we have a swing high at this swing, we have another swing high up here, and if we look below price, we have a swing low down here. So I'd consider these areas in price nearby to where price was, which means it's a relevant area to look at. Whereas if I'm on a daily chart now, we can look at this swing low down here and these very, very clean equal highs. I'd say that these areas of liquidity are not relevant because they're just too far away. That doesn't mean that they're not important. I'd say that these are very, very important levels, but there's a time and a place, and it's just not likely to reach at this point in time. If we look above price once more, we have some relative equal highs formed on Monday. So if we just do a quick comparison between this swing low, this singular swing low, versus these equal highs, which side would you say has more liquidity? And if you're thinking what I'm thinking, of course, these equal highs have much more liquidity when compared with this low. So for me, these equal highs would be the more likely objective. So my bias would be bullish, and I'd only focus on bullish patterns to reach this key area. However, you can see that my bias this day was actually bearish. So why did I decide to aim for this low, and why did I value this low over these equal highs? Well, if I go onto a 30-minute chart and I scroll to the left a bit, now you might be able to see that this singular swing low has actually made relative equal lows in many, many instances. So now if we do another quick liquidity comparison, we've got these two equal highs above and we've got these multiple equal lows below. Which side has more liquidity and which side is closer? Now it makes a bit more sense that these equal lows seems like the more likely objective. So just after that simple liquidity analysis, we've made a judgment based on logic that below price has more liquidity, which is a more likely objective, so that will be our bias. And this is just a very simple way to find a daily bias if you're only looking at one market. However, if you use correlating markets, for example indices and EU and GU like to move generally in tandem, if our bias we decided on S&P was to be bearish to those equal lows, if I click onto EU and GU, we'd want to find more reason for price to be bearish as well, and that would be an additional confluence for our bias to be bearish. So I'll go onto GU and we'll have a look before the 30th of November, and here on GU, before the 30th of November, just before that New York session, once again we do a liquidity analysis. If I look above price, we've got some swing highs, we've got some single swing highs, nothing too interesting other than these equal highs above, which are a little bit far away. But if we look below, we have this swing low and this swing low. But once again, this swing low is not just any ordinary swing. If you look to the left, that low also made an equal low. So if we do a little liquidity battle, this swing high versus these equal lows, which one has more liquidity? Of course, these equal lows have more liquidity. So if on GU we have a bias to be bearish towards those equal lows, and on S&P we also have the same bias to be bearish towards equal lows, this is just an additional confluence that can help you feel more confident about deciding which direction to be your bias. And just for fun, we'll really quickly just go on to EU, and I've already marked this out, but we had some equal highs up here. We had some equal lows down there, and just after those equal highs were taken, just after the equity open, you can see that price runs straight to those equal lows, since that was a very clear objective, not just on EU, but also on correlating markets. Alright, that covers daily bias for this video. I'm sure I'll mention it multiple times in later videos, but let's move on to the RMR pattern. And if you've seen any of my previous videos, you know that I like to trade using the RMR pattern. So above this swing high, as soon as price breaks through that level, we can call that the raid, and after the raid we look for the market structure shift. So after a bullish raid, we wait for a break in structure, a bearish structure shift, and we can see that price immediately breaks a swing low down here. So this will be the market structure shift. And finally, after that market structure shift, the last R is the return area, and the return area is just a broad way to find your entry technique. And we know that there are many entry techniques, but the most common and one of the easiest ones that I use is by using a gap. And during that bearish market structure shift, you can see a very clear gap. I'll just highlight it and drag it to the right. The significance of this gap acts as a return area. So when price retraces into that gap, that's where we can start to look for our shorts. And I'll just go through quickly some other return entry techniques. You could use a bearish order block, which is over here. You could use a breaker block, which is this bearish candle over here, which is overlapped with the gap as well as overlapped with the order block. And one final entry technique, you could use a Fibonacci tool. Just draw an anchor point from the top of the raid to the bottom of that market structure shift swing, which is over here. You don't want to place your fib at the end of this swing, because then you'd just be measuring the retracement of this leg. So instead we place the anchor at the bottom of this swing down here, which will measure how deep this retracement is. And a general rule of thumb is as long as price retraces above that 50% level, then it'll be considered a premium in price, meaning it is a very fair price to short. And you can see that where we placed our entry actually overlaps with all of these entry techniques. It's inside that breaker block, it's inside this order block, and it's also inside this gap. So you don't have to use all of these entry techniques, you really only need one. But sometimes it's nice to know all of your options so you can find an entry price which is common amongst all of those. Okay, so once I've placed my short entry, the first thing you can't forget about is your stop loss. And my stop loss for this trade was at the top of the raid, which is over here. And if you're feeling a little more aggressive, you can have your stop loss at the top of the gap, which is over here. And my objective, as you know, were those equal lows down below. And so on the way down, of course, if you place one entry and one exit, you'll get the most return for your trade. However, the way that I learned to trade and that suits my trading personality is to take partials along the way, but to ensure that these are taken at logical areas and not just because of emotional decisions. So my first partial, you can see I took off at an area of liquidity, this swing low. I'm just here on the Dow, and this swing low down here, once Dow broke that swing low, what time was it? That was at 10:15. So for my second partial, if you weren't sure why I took off something here, it may look like it was because of a swing low down here, but the real reason was because the Dow reached an area of liquidity, so I took off a partial on this trade at exactly 10:15. And my final partial, you already know, at those equal lows, and by then I'd only have 10% of my position to run, with my stop loss at break even and getting stopped out once the news ticked. Now I just want to say this news event was a high impact news event. On the 30th of November, it was the Fed chair speaking at 1:30 p.m. This is a high impact news event, and I would not recommend holding onto a position during the release at all. However, my justification for this is since it was only a 10% position, I was okay with allocating that risk. But even so, I still wouldn't recommend this practice. So definitely find out your own trading personalities when it comes to news. I know many people are comfortable during news. Many people avoid it completely, so find what suits you. Alright guys, final topic. The birds are chirping. Oh my god. It's 4 p.m. in New York, which means it's around 7 a.m. where I am. And do you think I slept all night? Most likely not. Oh my god, I'm so dead. But I said I'd make a video, so I can't go back on my word now. I'm gonna be leaving this country in a few hours, but I'm gonna get this video out for you guys. Don't worry about it. Okay, final topic, relative strength. Let's blast through this one. So I still see a boatload of comments regarding relative strength, how to use it, and is it effective? Long story short, these are my experiences and my findings, and I find it very helpful for my trading. So there's no need to take my word for it. Go in and test it for yourself, see what the results are, and then you can see if it's effective for your own trading. But long story short, let's measure the retracement leg like we did with the entry method. You can see that price has retraced to just above 50% level. Here on the Nasdaq, same fib from 8:15 to 9 o'clock. You can see price makes a much deeper retracement, almost at 80%. And finally, here on the Dow, once again at 8:15 to 9 o'clock, you can see that price has retraced further than 90%. So obviously the Dow was the strongest at around 90%, Nasdaq in the middle around 80%, and the S&P was the weakest at around 50-60%. So if we're looking to short, of course we want to short the weakest, which is S&P. And just as a little backtest experiment, if we placed a short on the Dow with the same entry method, at this gap, if we entered in this gap, we'd have our position here, we'd have our stop loss either at the top of that gap or at the top of that raid, and you can see that price would have been 1 or 2 points away from your stop loss. And realistically, if you didn't factor in spread and you put your stop loss at that price at that swing high, most likely you would have been stopped out. Whereas here on the S&P, you can see that not only are we ages away from getting stopped out, we also have the most precise entry as well. That would have went through the least amount of drawdown out of the three. And if you don't like going through drawdown and you want the most precise positions, then using relative strength for your entries can be a big help for that. Alright guys, I'm just going to clean up my chart in case you want to take a screenshot of the naked chart so you can outline the RMI yourselves. But that'll be it for this video guys. If you enjoyed it, leave a like and subscribe. It makes me very happy. And if you've got any questions, leave them down below. I'll get back to every single one of you as soon as I can. But I guess I won't be making any more videos until after Christmas time. So I wish you guys a very Merry Christmas. But until next time, take care everyone. Peace.